Everybody loves to blame the boomers. They had it easy. They bought houses for $30,000. They had stable jobs. So why are so many of them retiring broke? That's the surface-level narrative. But the real story is a lot more uncomfortable. Because the truth is this: many baby boomers didn't fail retirement. Retirement failed them. For decades, boomers were sold a very specific version of the American dream. Go to work, stay loyal, climb slowly, retire at 65, live off your pension and Social Security. That was the deal. And, for a while, it was real. In the 1960s and 1970s, a huge percentage of private sector workers had defined benefit pensions. You worked 30 years. You got a guaranteed monthly check for life. The company carried the risk, not you. Then corporations realized something. Pensions were expensive. Very expensive. So, they started replacing them with 401k plans. On paper, it looked modern, flexible, empowering. In reality, it shifted risk from billion-dollar companies to individual workers. Instead of a guaranteed check, workers now had an investment account tied to the stock market. If markets went up, great. If they crashed right before retirement, that was your problem. And here's what makes boomers unique. They were caught in the transition. Older generations often had full pensions. Younger generations grew up knowing they were on their own. Boomers were told they'd have security, and then halfway through their careers, the rules changed. Imagine planning your life around one system, only to have it quietly replaced. No national training, no serious financial education push, no required investing literacy. Just, here's your 401k, good luck. And that's where the cracks started. Most Americans were never taught how to manage long-term market risk. They weren't taught about asset allocation, sequence of returns risk, or how devastating a downturn can be in the final 5 years before retirement. Then came 2000. The dot-com bubble burst. Retirement accounts dropped hard. Many boomers were in their late 30s and 40s. They had time to recover. It hurt, but it wasn't fatal. Then came 2008. This one was different. Housing collapsed. Banks failed. The market lost more than half its value from peak to bottom. Now boomers were in their 50s and early 60s. This wasn't theoretical anymore. This was retirement money evaporating. And, unlike younger investors, they didn't have 20 years to wait for a recovery. Some delayed retirement. Some went back to work. Some simply never recovered the lost momentum. But market crashes are only part of the story. Let's talk about something even more powerful: wage stagnation. Yes, boomers saw economic growth in America. But starting in the late 1970s, real wage growth for middle-class workers began slowing down. Productivity went up. Corporate profits went up. Executive pay exploded. But average worker wages? They barely kept pace with inflation. At the same time, the three biggest life expenses, housing, healthcare, and education, began rising much faster than wages. So even if you were working consistently, the margin to save was shrinking. Saving 15% of your income sounds responsible. But what if rent or your mortgage eats 35%? Healthcare another 15%? Childcare? College savings? It's easy to criticize saving rates in hindsight. It's harder to acknowledge that the math became tighter every decade. Now add another layer. Boomers didn't just support themselves. They supported their children longer than previous generations ever did. Millennials entered adulthood during the Great Recession. Many struggled with underemployment, student loan debt, and delayed homeownership. Who stepped in? Mom and dad. Boomers became financial shock absorbers, helping with rent, helping with down payments, co-signing loans, covering medical bills. Some even took on Parent Plus loans for college debt they're still carrying into their 70s. Then there's the other side of the sandwich. Aging parents. Long-term care in America is brutally expensive, and Medicare doesn't fully cover it. So boomers often supported elderly parents while also helping adult children. That's not financial irresponsibility. That's family responsibility. And it drains retirement savings fast. Now let's talk about the house. Yes, many boomers benefited from rising home prices. But home equity is not the same as liquid retirement income. You can't buy groceries with drywall. Selling sounds simple. Just downsize. But downsizing often means moving away from community, healthcare networks, family. And in today's market, smaller homes aren't always dramatically cheaper. Property taxes remain. Insurance keeps rising. For many, the house became both their biggest asset and their biggest trap. Meanwhile, healthcare costs kept climbing. When boomers were young, healthcare consumed a much smaller portion of household income. Today, retirees face premiums, deductibles, drug costs, supplemental plans, and potential long-term care expenses that can wipe out six figures easily. Living longer sounds like a blessing. Financially, it's a stress test. Retirement used to last maybe 10 to 15 years. Now it can last 25 or 30. That means your savings must survive 3 decades without employment income. And if the market drops early in those years while you're withdrawing funds, that's sequence risk. It can permanently damage your portfolio. So when people ask why so many boomers are retiring broke, they're asking the wrong question. It's not just about spending habits. It's about a retirement system that transformed from guaranteed income to market dependency, from employer-backed security to individual risk management, from stable expectations to volatility. And millions of people weren't prepared for that shift. Not because they were lazy, but because the ground moved underneath them, and most didn't even realize it was happening. Here's something nobody likes to admit. The American retirement system today is basically a do-it-yourself experiment. And boomers were the first full generation forced to test it at scale. Think about it. For most of the 20th century, retirement was built on 3 legs: pensions, Social Security, and personal savings. That structure created stability. Even if you weren't wealthy, you had predictable income. But over time, one of those legs, pensions, was slowly kicked out. By the 1990s and early 2000s, private sector pensions were disappearing fast. Employers preferred 401(k)s because they were cheaper and shifted long-term liabilities off corporate balance sheets. From a business perspective, it made sense. From a worker's perspective, it meant uncertainty. Instead of asking, "How long do I need to work to qualify for my pension?" people now had to ask, "How well will markets perform over the next 30 years?" That's a completely different psychological burden. And here's the problem. Markets don't move in straight lines. Boomers experienced multiple once-in-a-generation events in their working lives. The oil crisis, the stagflation of the 1970s, the dot-com collapse, 9/11, and the economic slowdown that followed, the 2008 financial crisis. Then, just as many were nearing or entering retirement, the 2020 pandemic crash. Yes, markets recovered over time. But retirement planning isn't just about averages. It's about timing. If you were 30 during a crash, you could keep investing and benefit from recovery. If you were 62, you didn't have that luxury. Now let's talk about something else people underestimate: inflation. For years, inflation felt tame. Then suddenly, prices surged. Groceries, gas, insurance, utilities. For retirees on fixed incomes, inflation isn't an abstract economic concept. It's a pay cut. Social Security does have cost of living adjustments, but they rarely match the real experience of rising expenses, especially healthcare. And that brings us to Social Security itself. For decades, Americans believed Social Security would be a stable foundation. But here's the reality. Social Security was never designed to fully replace income. It was meant to supplement it. The average monthly benefit today is enough to cover basic expenses in some regions, but not comfortably in many others. If you don't have significant savings on top of it, retirement becomes survival mode. And millions of boomers are living exactly that reality. Another factor? Divorce. Boomers experienced high divorce rates compared to previous generations. Divorce late in life can be financially devastating. Assets get split, retirement accounts divided, legal fees accumulate. Two households are more expensive than one. And rebuilding savings in your 50s or 60s is incredibly difficult. Then there's job insecurity. The idea that boomers all had stable, lifelong careers is partly myth. Corporate restructuring, outsourcing, automation. These trends accelerated in the 1980s and 1990s. Many workers in manufacturing lost stable union jobs and had to transition into lower-paying service roles. When your peak earning years are disrupted, your retirement contributions shrink. Compound interest works both ways. Miss a few high-income years of contributions, and the long-term impact is massive. Now consider this. Financial advice became increasingly complex over the last 30 years. Target date funds, ETFs, Roth conversions, tax loss harvesting, required, minimum distributions. It's a sophisticated system, but most people don't have financial planners. They're making decisions alone. One wrong move, cashing out during a panic, investing too conservatively for too long, or taking on too much risk, can permanently reduce retirement outcomes. Boomers weren't just managing careers. They were navigating a financial maze that didn't exist for previous generations. And many did it without guidance. Now let's confront another uncomfortable truth. Longevity risk. People are living longer than ever before. At first glance, that sounds positive. But financially, it means something simple. Your money has to last longer than any generation before you. If you retire at 65 and live to 90, that's 25 years of withdrawals. If you miscalculate by even a small percentage annually, you can run out. And running out at 85 is far worse than running short at 65. This fear causes many retirees to underspend, living extremely frugally, even if they technically have enough. Others overspend early, assuming growth will bail them out. Both scenarios are common. Neither is easy to fix once retirement begins. Now zoom out. We often hear that boomers are the wealthiest generation in history. That's technically true in aggregate. But averages hide inequality. A small percentage of boomers hold a massive share of total wealth. Many benefited from stock market growth, real estate booms, or high-paying professional careers. But the bottom half? They're exposed. Limited savings, rising costs, no pension, heavy reliance on Social Security. When critics say boomers had it easy, they're often thinking of the top tier, not the median worker, not the factory employee who lost a job in 1994, not the retail worker who never had a pension to begin with, not the small business owner whose savings evaporated in 2008. The retirement crisis isn't uniform. It's uneven. And that unevenness is what makes it harder to see. Because, from the outside, America still looks wealthy. But underneath, many older Americans are quietly stretching every dollar, delaying medical care, working part-time in their 70s, helping grandchildren while cutting their own expenses. That's not laziness. That's structural pressure. And here's the deeper question. If boomers, who benefited from cheaper college, lower home prices relative to income, and stronger early career growth, are struggling under this retirement model, what does that mean for the generations behind them? Because the system didn't revert back. If anything, it became even more market-dependent. That's where this conversation becomes bigger than one generation. Let's go even deeper. Because money isn't just math, it's psychology. And retirement is where financial psychology becomes brutally real. For most boomers, retirement wasn't just a financial milestone. It was an identity shift. They grew up in a culture that tied personal worth to work. Your job wasn't just income, it was status, structure, purpose. So when retirement approached, many weren't just asking, "Do I have enough money?" They were asking, "Who am I without my job?" That psychological hesitation caused delays. Some worked longer by choice, but many worked longer because they had to, even if they didn't admit it openly. Now here's where it gets uncomfortable. A large portion of boomers assumed markets would continue delivering the kind of returns seen in the 1980s and 1990s. Double-digit annual returns became mentally normalized. But long-term averages include long flat periods. The lost decade from 2000 to 2010 was devastating for retirement accounts. If you were contributing consistently, you might have recovered. But if you were near retirement and relying on growth, that decade hurt badly. And then came low interest rates. For years after 2008, interest rates stayed near historic lows. That helped borrowers. It punished savers. Traditional retirement advice used to rely on conservative fixed-income investments generating 5 to 7% yields. That world disappeared. Suddenly, retirees faced a dilemma. Take more risk in stocks, or accept very low returns in bonds. Either option carried stress. Now add rising insurance costs into the mix. Homeowners insurance in certain states has surged dramatically. Auto insurance followed. Long-term care insurance premiums climbed or policies were canceled entirely. These are not optional expenses. They quietly erode retirement budgets. Then there's taxation. Retirees quickly learned that Social Security can be taxable. Withdrawals from traditional 401(k)s are taxable. Required minimum distributions force withdrawals whether you need the money or not. Healthcare surcharges can increase Medicare premiums if income crosses certain thresholds. The retirement tax landscape is far more complex than most people anticipated. And complexity increases mistakes. Now, let's talk about one of the biggest silent threats: caregiving. Millions of boomers became unpaid caregivers for spouses or elderly parents. Caregiving often forces early retirement. Early retirement reduces Social Security benefits permanently. It reduces 401(k) contributions. It shortens peak earning years. The financial impact compounds quietly. And once you step out of the workforce in your late 50s, re-entering at the same salary level is extremely difficult. Age discrimination is rarely discussed openly, but it exists. Older workers who lose jobs often accept lower-paying roles just to stay employed. That income reduction directly impacts retirement savings. Now zoom out again. We like simple narratives. They should have saved more. But what if the real issue is that the retirement model requires near-perfect execution over 40 years? No major health crises. No prolonged unemployment. No divorce. No market crash right before retirement. No extended family financial emergencies. No poor investment decisions. No caregiving interruptions. That's a very fragile system. It only works smoothly under ideal conditions. And life is rarely ideal for 4 straight decades. Boomers weren't uniquely irresponsible. They were uniquely exposed to systemic shifts. The shift from pensions to 401(k)s. The explosion of healthcare costs. Wage stagnation. Increased longevity. Market volatility during key retirement windows. Higher education costs that spilled into family support. Rising housing costs later in life. The disappearance of long-term job stability. All of these forces collided during their lifetime. Now here's something even more subtle. Many boomers didn't expect to live this long. In the 1980s, life expectancy was lower. Planning for 30 years of retirement simply wasn't common thinking. Today, outliving your money is a real fear. And fear changes behavior. Some retirees hold too much cash. Some avoid investing altogether after experiencing crashes. Some refuse to spend even when they technically could. Financial trauma is real. The generation that watched 2008 unfold doesn't forget that easily. Now think about what retiring broke actually means. It doesn't always mean $0. Often it means insufficient income relative to expenses. It means constant budgeting stress. It means relying almost entirely on Social Security. It means working part-time, not for stimulation, but for survival. It means delaying medical procedures. It means choosing between home repairs and travel to see grandchildren. It's not always visible from the outside, because many boomers still own homes. Many still appear stable, but liquidity and cash flow tell a different story. And here's the irony. This generation was often labeled as the luckiest in American history. They grew up during post-war expansion, but they also lived through the transformation of the entire economic structure. They were the bridge generation, the last to taste pension security, the first to carry full market risk, the last to see relatively affordable public college, the first to experience exploding tuition for their children, the last to buy homes before extreme price acceleration, the first to retire into a hyper-financialized economy. They weren't insulated. They were transitional, and transitional generations often absorb the shock of structural change. So when critics reduce the issue to avocado toast logic, they miss the systemic story. Because if a retirement system requires individuals to be perfect investors, perfect savers, perfectly healthy, perfectly employed, and perfectly lucky for 40 years, then maybe the flaw isn't entirely personal. Maybe it's structural. And that's where this conversation becomes bigger than boomers. Now let's step back and ask the question nobody really wants to confront. What if the retirement crisis we see among boomers isn't a generational failure, but a preview? Because here's the uncomfortable truth. The system that boomers struggled with, it hasn't been fixed. If anything, it's become even more dependent on markets, personal discipline, and economic stability that no longer exists. Boomers were the first generation to experience the large-scale shift from guaranteed retirement income to self-managed investment accounts. Gen X inherited that system fully. Millennials entered the workforce after watching two historic crashes before turning 30. Gen Z is starting adulthood in a world of record debt levels and housing affordability crises. The risk didn't disappear. It multiplied. But let's stay with boomers for a moment. There's another factor people rarely discuss: expectations. Boomers grew up during a time when upward mobility felt natural. Each decade seemed better than the last. Wages rose. Suburbs expanded. Credit became accessible. Consumer culture flourished. There was a deep cultural belief that tomorrow would be richer than today. That belief shaped spending behavior. It shaped borrowing behavior. It shaped lifestyle inflation. And when you live through decades where the economy expands consistently, you begin to assume expansion is permanent. Then stagnation hits. Then volatility hits. Then inflation returns. And suddenly, the long-term plan doesn't feel so stable anymore. Another overlooked element? Medical breakthroughs. Boomers benefited from longer life expectancy because of advances in medicine. But medical advancement is expensive. New treatments, new technologies, extended care. Living longer means consuming more healthcare over time. And healthcare in America is not cheap. Even Medicare doesn't eliminate out-of-pocket costs. Long-term care can run $80,000 to $100,000 per year in many states. One extended illness can erase decades of disciplined saving. That's not mismanagement. That's exposure. Now let's talk about labor force participation. You've probably noticed more older Americans working today than in previous generations. Some are working because they want social engagement, but many are working because they need income. Retail, consulting, gig work, driving, contracting. Retirement has quietly shifted from a hard stop at 65 to a gradual phase-out, sometimes lasting into the mid-70s. This isn't how retirement was originally marketed. The image was leisure, travel, relaxation. Instead, many are balancing part-time income with rising living costs. And here's another subtle issue: geographic lock-in. Many boomers own homes in areas that appreciated dramatically. But moving isn't simple. If they sell, they face capital gains considerations. If they move closer to children in high-cost cities, they may end up paying more. If they rent, they're exposed to rising rental markets. Housing equity looks powerful on paper, but unlocking it safely without increasing risk is complicated. Reverse mortgages exist, but they're not universally understood or trusted. And again, complexity increases hesitation. Now here's something structural that rarely gets discussed on mainstream platforms. The American retirement system assumes consistent economic growth. It assumes financial markets trend upward over long horizons. It assumes political stability. It assumes Social Security remains solvent. It assumes healthcare inflation doesn't spiral. That's a lot of assumptions. And boomers experienced enough disruption to test every single one of them. The irony? Many boomers did exactly what they were told. They worked 30 to 40 years. They bought homes. They contributed to retirement accounts. They trusted institutions. And, still, a large percentage entered retirement financially fragile. That should raise deeper questions. Not about one generation's discipline, but about systemic design. Because if a large share of a generation that lived through one of the most economically powerful eras in U.S. history can still retire financially stressed, what does that say about the resilience of the model itself? This isn't about resentment between generations. It's not about blame. It's about structure. Retirement used to be a collective responsibility shared between employer, government, and worker. Today, it's primarily individual. And individual systems amplify inequality. Those with financial literacy, stable careers, and strong health outcomes often do fine. Those who face disruption struggle. Boomers didn't all retire broke, but enough did to expose a crack in the foundation. And that crack didn't form overnight. It formed slowly, quietly, over decades. Now the bigger question isn't why some boomers are struggling. The bigger question is this: if the system produced this outcome for them, what outcome is it producing right now for everyone else? Because retirement isn't failing suddenly. It's evolving silently. And silence is what makes it dangerous. That's the real reason this conversation matters. Not just for boomers, but for the future of retirement in America itself.